Fannie Mae and Freddie Mac are quietly expanding their role in the mortgage market, and that move is raising new questions about what it could mean for mortgage rates, housing affordability, and their future as publicly traded companies. Recent financial data shows that both government-sponsored enterprises have significantly increased the amount of mortgage-backed securities they hold on their balance sheets. Over the 5 months leading up to October, their retained mortgage portfolios grew by more than 25%, bringing total holdings to roughly $234 billion. That's the largest combined portfolio the two have held since 2021. Some analysts believe this growth isn't finished. If current trends continue, estimates suggest Fannie Mae and Freddie Mac could add as much as $100 billion more in mortgage-backed securities by 2026. Why does this matter? While federal officials haven't publicly explained the recent buying activity, policymakers have repeatedly said they want to use the financial strength of Fannie and Freddie to help lower housing costs and support mortgage affordability. At the same time, the firms appear to be positioning themselves for a potential exit from government conservatorship, nearly 2 decades after the 2008 housing crisis. By increasing their retained portfolios, Fannie and Freddie can support mortgage bond prices, improve earnings stability, and reduce the supply of mortgage-backed securities available to private investors. All of that can help keep mortgage rates from rising too quickly while also strengthening their balance sheets ahead of a possible return to public markets. It's important to remember that Fannie Mae and Freddie Mac don't issue mortgages directly. Instead, they buy loans from lenders, package them into mortgage-backed securities, guarantee those bonds, and sell them to investors. When they choose to hold more of those securities themselves, fewer bonds hit the open market, often helping stabilize borrowing costs. This strategy isn't new. In the decades before the housing crash, retained portfolios were a major source of profit for both firms. But when the market collapsed, those large holdings became a major risk, leading to massive losses and federal takeover. Today, however, the situation looks different. Even after recent growth, Fannie and Freddie remain well below their regulatory portfolio limits, with more than $200 billion in remaining capacity. Whether this strategy ultimately leads to lower mortgage rates will depend on economic conditions, investor demand, and regulatory decisions. Still, one thing is clear: Fannie Mae and Freddie Mac are becoming more active players again, and their moves could shape the mortgage market in the years ahead. For direct financing consultations or mortgage options, visit Right Finger Nadlin Capital Group.